Let me introduce myself first. I am Syed Mujtaba Hussain. I am a member of the Standing Committee on Climate Finance, and I work for the Government of Pakistan in the Ministry of Climate Change as Deputy Secretary. Now I'll introduce the distinguished group of panelists. On my left, first, I have Mr. Yu Sili, Vice Chair of the CDM Executive Board. Next to him is Mr. Abid Karmali from the Bank of America. Sitting next to Abid is Vikram Vij from the International Finance Corporation. And on the last seat is Mr. Jose Juan Gomez from the Inter-American Development Bank. In the interest of time and to catch up on our schedule, I will have some targeted questions towards each panelist to reflect upon. My first question would be, I would request you to respond on the role of subsidies in supporting industry sectors, particularly what are the implications of promoting clean technologies and energy resources. What can be done to revert traditional subsidies into clean energy technologies? The second question to you would be, what are the key expectations about market-based and non-market mechanisms to support mitigation actions? How can countries ensure adequate readiness? To Vikram, some of the key questions to reflect upon would be, what are the current and potential trends on climate mitigation-related investments? How can public finance drive private sector investments? How does the current state of carbon markets influence overall climate mitigation finance? To Abid, some of the key questions would be, what are the factors influencing private sector decisions to invest in climate change mitigation? What are the market and policy barriers to private sector investments in climate mitigation and ways to overcome them? What possible new approaches can be taken by both public and private actors to unblock new flows? To Jose Juan, some of the key questions would be, what experiences can regional multilateral development banks share on mobilizing of financial flows and capital markets to support national and regional climate change policies? Is there enough supply of financial resources? What is the capacity of demand side to absorb these flows? How does this apply from a regional and even international perspective? What are the challenges and opportunities to enhance the capacity of demand side to put forward bankable projects and programs? Other potential questions for the panelists would be, nationally appropriate mitigation actions are an emerging approach for mitigation. At the national level, what lessons can be drawn at this stage on structuring and mobilizing investments and financial flows from NAMAs? Are there special considerations that need to be taken into account by policymakers, practitioners, investors, and other stakeholders? Each panelist will have 10 minutes to reflect upon these questions. And then in the end, we have time for some targeted questions from the audience. Now, I would request you to speak on the first set of questions. You may like to stand up.
It doesn't matter. Thank you, Syed. I'm going to cheat and not answer your questions directly, but be tangential in my responses. Ladies and gentlemen, I'm wearing two hats here. I've been invited because I'm the Vice Chair of the Clean Development Mechanism Executive Board, and so I'm expected to talk about markets, and I will. But I'm also, or have been, the energy advisor to the governments of Barbados, Dominica, St. Lucia, Grenada. And I'm an engineer. I'm not an economist. Therefore, finance for me is just a means to an end. It's allow me to build things. And therefore, I will wish to take this opportunity to pass on some of the real hurdles that we've met in the Caribbean as well. And small islands, I think, are a potential role model. I think we face the same issues that larger countries face, but there's just a difference in scale. So I believe that we can be role models for the rest of the world. But let me start with the markets. I've just come from a CDM Executive Board meeting. It started yesterday. I will go back tonight to Bonn for the rest of that meeting. The first day of the meeting was fairly depressing. As you can recognize, the markets have crashed. The CDM has been historically a success. We've managed to register over 6,000 projects now. We've managed to facilitate investments of over $200 billion in developing countries. However, we're down to less than 2 registrations per week now, post December 31st, 2012. We're losing the infrastructure. The private sector capacity is being redeployed. And that's a serious, serious issue for us. Now, how we deal with this? We need to increase demand. It's as simple as that. We've done all we can within the board to facilitate access to the CDM. We've brought about a loan scheme for countries that are underrepresented. We've created positive lists like renewable energy and energy efficiency with reduced requirements to prove additionality. But we can do nothing if there's no demand. Second point I want to get across about markets is why this mad rush to integrate domestic markets with the markets under the convention. Why this mad rush? And it's even a theme under the Carbon Expo. Do you really think that integrating Quebec and California with the CDM and the GI is going to solve the problem? How are we going to maintain environmental integrity? So here's some pushback. Don't go down that line unless you're serious about maintaining environmental integrity, unless you're serious about saying that 1 ton of carbon is 1 ton of carbon around the world, and allow for international oversight. Third point about markets. The premise about moving towards a new market mechanism appears to be that the CDM is not scalable, that the CDM cannot achieve the scale of mitigation required. That premise is flawed. If you look at the data that came out of 2012, you will see that the CDM achieved an order of magnitude of scalability. The demand came because everyone wanted to get their projects in before December 31st, 2012. As a result, the CDM registered projects to the equivalent of 0.4 gigatons of CO2 reductions. And that's an order of magnitude higher than we've ever done before. From 2000, if you took the average from 2005 to 2010, we whooped that average in 2012. So don't tell me that a project-based mechanism is not scalable and we need to move to a sectoral mechanism where we cannot determine additionality, where we cannot determine environmental integrity. Wrong direction. Don't go there. Let me switch to small islands. Where I'm coming from is the Caribbean. The region is blessed with copious quantities of renewable energy, wind, solar, geothermal. But yet, we're heavily dependent on imported fossil fuels. Why? Well, there's a little saying that goes, conventional energy systems burn fossil fuels, renewable energy burns capital. And we need access to affordable capital. And as I said, I'm an engineer, so I'll be very, very straight with you. If you ask me to borrow money at 7% to build a solar farm, I cannot do it. If you lend me money at 3% or less, we can get it done. I was extremely surprised when I heard Barbara remark that there was $364 billion US floating around there in low climate finance every year. $364 billion. Well, where's that money? Because we're not getting it. We can turn Grenada, the island that I'm from, into 100% renewable energy and call it green ADA by 2030, if we got access to 150 million, that's with an M, not a B, 150 million US dollars at low interest. I'm not asking for a grant either. Now, I did a quick calculation. There were a number of zeros. I'm not sure if my calculator could handle it, but that worked out to 0.04% of the $364 billion that you say is floating out there. Give us the money at low interest, and we can prove that we can go 100% RE. But before I talk about the RE, let me talk about energy efficiency very, very quickly, because we tend to leave energy efficiency out of the link, and that's a mistake. Even before we move to renewable energy, we've got to make our systems more efficient. I'm talking about generation efficiencies, transmission and distribution losses, and of course on the demand side. On the demand side, we also include water use efficiency, building codes, energy efficiency standards for appliances. The constraint is it's the same with renewable energy. A hotelier knows that he's being energy efficient or energy inefficient. He does not have the money, or she does not have the money to retrofit their hotels. So it's, again, access to finance. And please bear in mind, colleagues, that we're dealing with countries that are under IMF programs with debt to GDP ratios of greater than 100%. The other point I want to get across about renewable energy, of course, is that the constraints appear to be different depending on the technology. I mean, you have to drill down. So one glove does not necessarily fit all. With geothermal, which we are blessed with, the entire archipelago, except for Barbados, is volcanic in origin. And therefore, a number of countries, a number of the islands in our region have potential geothermal, yet none of them have developed that geothermal potential, although it's base load. It's not intermittent, it's firm energy. And one of the big problems is the drilling risk fund, or a lack of a drilling risk fund. For us in Grenada, we have to spend about 20 million US dollars upfront with a 20% chance of hitting the steam. The government doesn't want to do that. The utility company does not want to do that. So we're searching for a geothermal partner. The problem is, if we find a geothermal partner with big enough pockets that they'll say, yes, we'll spend $20 million to drill these wells and find the steam, they, of course, would want a 70 to 80% equity stake in any special purpose vehicle that's set up. So you're actually then moving away from one monopoly to another. So how do we get around that? How do the governments of the region find the funds to find the steam? Once the steam is found, you can go and get a commercial loan because you have a proven resource. It's the upfront risk that's the problem. Waste to energy. Waste is recession-proof. So we continue to generate copious quantities of waste, but perhaps not enough. The problem with waste is economies of scale, lack of scale. We are not generating actually enough waste for it to be feasible to set up incinerators. However, we can find the appropriate technology. If that's anaerobic digestion, then perhaps we can move forward. Solar and wind. And I'm talking about now about distributed generation, small rooftop-mounted systems. And this is the direction we want to go in. Here we find it's not necessarily finance that's the problem. It's policy and grid stability. The cost of solar systems has come down, at least in our region. They used to be around US $6,000 per installed kilowatt. We're now down around $4,000 US dollars per installed kilowatt. And by the way, it's cheaper for us to fly to China and bring back these units than to buy them out of the EU. So we're getting our solar panels right now from Singapore and China. I noted on CNN yesterday that the EU wants to slap tariffs on China because they believe that their solar panels are too cheap. I wonder who's being myopic. So the issue with solar is that we have a vertically integrated monopoly. And they have an Electricity Supply Act, they have a contract that says we are the only ones that can generate electricity up to 2078. The other structural problem that we have is that in the 1970s, in the first oil crisis, we introduced a fuel charge. And we allowed the utility companies to pass 100% of this fuel charge onto the consumer. So here we have a system where we have utility companies, both state-owned and private, that are monopolies and have no incentive to switch from the fossil fuels because they can pass on 100% of the fuel charge to the consumers. Problem. So what do we need? We need to break those monopolies without going to court, and that's going to need some help. We need interconnection policies that are equitable, and this is both for distributed generation and concentrated generation of renewable energy. And we need equitable feed-in tariffs. One of the problems that we have, of course, is that fossil fuels are still sitting there in the background, natural gas in particular. And natural gas is being touted as a transition fuel. Give me a break. If we switch from importing diesel, as we are now in Grenada, to using natural gas, there will be an immediate short-term benefit to the consumer. But we're going to lock ourselves in for the next 30 years into a natural gas infrastructure. And that's a big, big worry for people like me. How do you convince the politician not to take that short-term step and lock themselves into an infrastructure that he cannot now get out of for the next 30 years? Petrocaribe. It saved our economies in 2008 and 2009. For those who are not familiar, Petrocaribe is a quasi subsidy provided by Venezuela to its brothers and sisters in the region. And we are extremely grateful to the Bolivarian Republic of Venezuela for saving our economies in 2008 and 2009, when the cost of imported fuel rose to 18% of our total import bill. However, I do have a question as to whether continued reliance on something like Petrocaribe is going to delay the inevitable decisions that we will have to take to reform our energy sectors. So I think I've said quite a bit, so I'm going to stop there and perhaps take questions as they come along. Thank you.
Now I would request Abid Kamali. Yeah, please.
Sure. I'll come up here.
Wherever you're comfortable.
Actually, I'll stay here. So thanks very much to the Standing Committee for inviting me to be here. It's a great pleasure. What I'd like to do is present to you some thoughts on the questions that Syed raised. I think before I do that, if it's possible, I wanted to try and marry up some of the issues from the previous panel. So, Mariama, you presented in your opening remarks, I think, a really important piece of the answer to the question raised by Anthony about how we try to embed this consciousness about climate change to try and deliver more finance by presenting a framework that speaks to mitigation, adaptation, and if I can paraphrase a little bit, two additional components. One is suffering, and then the fourth one is economic dislocation, which in the UNFCCC jargon, I guess, becomes loss and damage. But I think, by being very explicit that every climate strategy each one of our entities takes, whether it's a company, whether it's a government, actually consists of those four elements, then I think we're being honest about, what our approach is. And I think that's one of the ways to shift the discussion with, with consumers. The second point I wanted to make is clearly if we don't achieve a massive shift towards mitigation, and this panel is actually solely on mitigation, then clearly we're going to have a significant increase in the other three parts of that strategy, i.e. we'll need more money for adaptation, we'll need more, there'll be more impact from on suffering, and there'll be more economic dislocation. So the critical question, I think, for us on this panel is how do we achieve significant scale-up at speed into the low-carbon economy? That's not disrespecting the adaptation agenda. It's just, I think, a reality that for us to have hope, we need to achieve that scale. And so therefore, thinking back to now Barbara's diagram and Paul's question about the push and pull factors, what we really should be thinking about is how can we mobilize significant flows of capital? Because the private sector is already delivering significant flows of capital, but there's a lot more that can be done. And Takashi talked about the role of institutional investors as an example. On the diagram, Barbara, institutional investors are currently a tiny, tiny box. There's a lot more potential to be tapped there. So now let me give you my, the perspectives from where I'm coming from, because many of you may not be familiar with what a global investment bank, Bank of America Merrill Lynch in this case, does in the climate finance space. So we had a target in 2007 at the corporate level to try to deliver $20 billion over 10 years, and that target was met 4 years early. We ended it in 2012, and then we started, we announced it in Rio, but then it starts this year, a $50 billion target over the next 10 years. And what we've seen is that across the different businesses that we're in, whether it's capital market activity, both equity and debt, whether it's leasing, clean energy leasing, for example, energy efficiency and renewable energy, whether it's principal investment or carbon markets, but I take Hugh's excellent comments on board. Carbon markets are clearly shrinking. Or whether it's other financial intermediation or risk management that we're offering to the likes of the institutional investors to try and attract their capital into the low-carbon economy, there is a lot of appetite out there from different types of investors. And we feel quite confident that we'll be able to deliver that $50 billion over the next 10 years simply because of the array of opportunities that we're seeing. So that gives me confidence. Now, the first question you asked, Syed, was about, so what's impeding these significant flows? What could come in the way of organizations like us being able to hit our targets and donor governments achieving the same and the international community through the various mechanisms that are being set up? What could come in the way? I think in simple terms, there are 4 major barriers. And all of them relate to the fundamental 2 points which investors care about: risk and return. Those are the only 2 metrics that matter from a private sector perspective. It all comes down to the same decision: will you or will you not invest in a particular opportunity? It's binary, completely binary. So what you have to appreciate is that an investor can undertake a whole bunch of due diligence, look at an opportunity, but ultimately can come to the conclusion, the bad outcome in this case, that sorry, this investment doesn't meet their particular metric. So let's dig deeper into what affects the risk and reward, or risk and return, and what's impeding more flows, since that was the question there. So if we think about the first one, policy risk, and I think this gets at the heart of Paul's comment about the need for more push-pull analysis. Policy risks from a private investor standpoint boil down to, does this opportunity come with investment-grade policy? Investment-grade policy could be energy policy, could be climate policy, tax policy, VAT. In fact, you heard some very real examples from Hugh here about practical policy constraints in the Caribbean, about what's impeding more flows into geothermal and solar, et cetera. So it's that array of policy risks which from an investment standpoint, you have to then translate into some kind of risk adjustment on what you expect to get from your project or from your investment. In addition to, by the way, the macroeconomic risks, the interest rates, the gentleman in the front here talked about interest rate fluctuations and foreign exchange. Those are macro issues which may in fact already screen out you from investing in that particular opportunity if you find you can't hedge some of those risks. So that's the first bucket. The second one is really about cash flow. So it's about what is the cash flow profile of the particular low carbon investment. And again, Hugh, I'm going to come back to you because you gave some very good examples about the cash flow profile of geothermal investments. You need to do the upfront, where's the steam question, right? Who's going to pay for that? Unlikely that the private investor is willing to make that bet unless they are really, really keen on geothermal and they're willing to take the risk that it may not deliver an investable project. So I think the challenge all of us face is that low carbon technologies have different cash flow profiles to business as usual. It doesn't mean that those are necessarily going to be barriers to investment. It's just that most investors are used to a certain type of cash flow. And unfortunately, investors are lazy for the most part. If they can get the same return from doing the same thing over and over again, well, that's probably where they'll go first. There's a risk aversion, naturally. So what it means, though, is that sometimes there is this viability gap, this cost gap that we need to address. And I think that's where the international community needs to focus on how can we reduce that viability gap, sometimes through mechanisms. The CDM was great. Maybe I shouldn't write it off. The CDM is great at delivering that sweetener on the return, the finance through the carbon market. Let's think about other mechanisms like that that can replicate delivering the extra return. I just realized that the third category I've kind of covered already, which is the macroeconomic risk. So let's skip that one. The fourth one is liquidity. Now, this one is the most difficult one to perhaps get across. But every private investor wants to know not only what will they get from investing in a particular opportunity, but how do they exit that investment. They don't want to be invested in that opportunity forever. And so that's why things like use of the capital markets and green bonds, and Mariama, again, you spoke about green bonds briefly. Green bonds are very important because if you can get tradable instruments in the debt capital markets with green bonds, then that becomes a liquid investment. Investors know they can go in, then they can sell the bond to somebody else that wants to hold it perhaps later on over that life of the bond. That's a good example of how we can create liquidity in the low carbon space. I'll just briefly touch on the other questions you raised, since I think I've tackled the issue of what affects private sector decision, what impedes private sector decision. Maybe just a brief word then about the different ways that we can mobilize more private sector, so thinking more about the solution side of it now. I think, when we step back and we try and come up with solutions, and I know Vikram's going to touch on this, so I won't get into too much detail on specifics. I think there's really three kinds of approaches we need to be thinking about. One is what kinds of instruments can deliver the additional return either on equity or on debt. And again, thinking about some of the examples we've spoken about, the carbon market has been good at that. It delivers monetized carbon benefits, which investors can realize through the existence of a liquid forward curve in carbon. The second example would be ways to cheapen the debt, to lower the cost of debt. Because again, thinking about Barbara's spaghetti diagram, in the private bucket, the biggest chunk of private capital was actually debt. And that makes sense because low carbon infrastructure is usually on the order of 70-30 debt to equity. So a key question for policymakers is how can we find ways to cheapen the debt? And that, by the way, will ensure that we get to the end of that financing cycle for every given project or opportunity, and the project will get to the binary outcome we want, which is, yes, we've managed to get financial close, and now we're going to implement that project, and then we can turn to the engineers and deploy it in the most cost-effective way. The third category of instrument is one that is probably most challenging to talk about because it is not really pure investment for investment's sake, but it's getting at this concept of equity in a different form, delivering the triple bottom line, as was talked about earlier. And what we've seen in many of the opportunities we've come across is that oftentimes there are low carbon social enterprises that have got brilliant models, brilliant business models, brilliant venture ideas. They simply lack the initial seed capital. Maybe they're some of the MSMEs that you talked about in the developing world. And most private finance is not reaching them. We have to be very candid about that. So the question is, are there some new approaches we can foster that provide that seed capital to deliver triple benefits? We will get emission reductions. Yes, it will be the 5% of emissions globally in the 100 countries, but that's a critical part of the challenge, politically, I understand, to get consensus about how we deploy capital. And they will deliver significant poverty alleviation benefits as well. So let's not forget about that third category of approaches, and some of the mechanisms, in general terms, could be revolving funds. If we really believe that those ideas are going to deliver significant returns over time, then it's about seeding capital which can be repaid in revolving funds. So let me leave my comments there. Thank you.
Thank you, Abid. And in the interest of time, I will now switch over to Vikram Vij.
Actually, just stand up if that's okay. Good morning, everybody, and let me join Abid in thanking the Standing Committee and the Secretariat in having me here as well. I'm going to actually try and address the questions I had posed. I'm going to make a few general observations and then perhaps end with a few more on what it might actually take to mobilize or leverage public or use public funds to leverage private money and what we have learned from our own operations so far. So in terms of kicking it off, then I think, in terms of, we are fairly definitely able to say that public funding and associated market mechanisms can definitely extend the reach and impact of the private sector by helping leverage the funding that they bring to the table. It provides sufficient buffers as structured appropriately that it makes it attractive for the private sector to come in, and it will bring a lot of leverage. And it is across all project sizes, the large ones that can be funded directly by banks and multilaterals, but as well as the smaller ones that actually tend to be more financed domestically, especially through domestic financial institutions. The issue, of course, is the Bloomberg New Energy Finance reports that last year it was about $270 billion for clean energy globally that was deployed. And while it was a little lower by 10% or so from the year before, a lot of it was attributed to actually the good news of reducing costs in the clean energy technologies. But the point is that it still needs to be 3 to 4 times that in terms of what various estimates put at about $800 to $1 trillion needed globally for clean energy investment, bulk of it in emerging markets. So that I just leave as a point as to what it implies in terms of capacity for absorption in the developing countries and the capital markets that serve those markets. The other point I wanted to sort of note, sort of emerges in this discussion, is that the private sector is not homogeneous. It's not one big monolith. Project sponsors are different, financial institutions are different, even institutional investors that we referred to are not uniform. You can put them in as many buckets as they tend to put their investment categories in. So that's, I think, important to note in terms of designing any sort of flows of new funds, that requirements vary across different parts and different types of the private sector. And there's nothing that there's no product or structure that sort of will one size fits all. So important to note in that context of how we can leverage public funding. Speaking of the financial sector, I think that's really where a lot of the turning point towards going to transformation and scale is going to come from. Banks tend to be quite, how shall I put it, risk averse, but in spite that wouldn't be demonstrated by some of the crises that were precipitated, no offense, Abid, but banks can move markets one way or the other. So I think that's key, but it tends to be also very risk averse in the context of financing new technologies or looking at new business models. And I think that is something that needs to be addressed. Then there is the other segment of the financial sector, which is the institutional investors. A lot of talk about the institutional investors. They control nearly 70 trillion. They're sitting on $70 trillion worth of assets. If you could unlock 1% of those, we'd pretty much be done. But the question is, if that is the Holy Grail, does it share other attributes of the Holy Grail in the sense that it is impossible to find and potentially ephemeral? And I think that is a question we need to ask ourselves, is this risk-return combination that I think Abid rightly pointed out critical? Can that be met for them? Or do we need to look at it somewhat differently? Not to put everything on the private sector and public funding, but I think it's important to also note that public policy adjustments in developing countries can magnify the impact that climate finance can have. It can range from the large and not to be touched today topic of fossil fuel subsidies and the related reform to what is very relevant on a pretty daily basis for private sector operations, things like policy risk. Spain is an example, Bulgaria was another one, where projects were subject to retroactive changes in their feed-in tariffs and other issues that can cause not only grief for that project, but sour the market for financing of other similar projects. There are things like progressive policies like renewable portfolio standards, but are they enforced? And without the appropriate enforcement, can you actually generate the sub-markets in renewable energy certificate trading and stuff like that, that the private sector has relied on in order to finance the projects in the first place? So those are the issues that we need to sort of look at. And finally, let's not write off the carbon market. I mean, it may not exist. I mean, and I say write off because the CDM and the general market is in such disarray as reflected in the price. But while it's not a panacea, I think without markets, we're not going to get where we really need to. The price on carbon is critical. The institutional investors are calling for it. And markets will actually have to reemerge. They'll look different. They'll probably be regional. They'll be fragmented. There'll be multiple asset classes. But hopefully, they'll all ultimately get networked. But none of that's going to happen without the ambition or the demand that is driven by the ambition for mitigation that has to come from the political process. I guess I'll go ahead and disagree with you a bit and actually put forth the notion that environmental integrity can potentially be maintained even across different standards and different emerging sort of asset classes. And rather than dwell on that now, I'll put a plug in for a side event, a plenary on Wednesday afternoon that talks about globally networked market at the Expo for those of you attending, and a side event at 11:30 on Thursday that is actually going to talk about and engage with the broader audience in a dialogue around the future of these kind of network market, different asset classes, environmental integrity. So I'll leave it at that. So just to sort of close out, I want to make 5 quick points on what will it take to, and I'm watching my timer here, so in the 2 minutes that I have left. If transformation is the goal, then I think public funds need to be fit for purpose. We need to look at the model at which we are delivering. We started on a very retail basis with the GEF. We moved to a somewhat country-driven programmatic approach under the SCFs. So what does it mean for the GCF? And I know the word wholesaling seems to have a different meaning for whoever you talk to, but completely from a private sector perspective, I'd just say instruments that help mobilize to scale rather than look at project by project would be one appropriate way of deploying the money. Approval processes and the criteria relating to that need to be efficient and clear. The private sector, as our friends at Deutsche Bank say, thrive on transparency, longevity, and certainty. Whatever's put in place, leave it in place, and just sort of make sure that it's like catnip is for cats. I think predictability is to investors. Products that help unlock institutional investors and those that unleash domestic capital markets. This comes back to the point I was making. 2 points here. We may probably need to look at incremental risk rather than incremental cost. I think risk can go a long way. Addressing risk can go a long way in addressing a lot of the issues that Abid talked about. Cheaper debt. Well, debt is priced based on stacking up of all the risks. Can we address some of those risks? And again, we should be looking at risks that are for the private sector, not business as usual. These are not risks that the public sector should be taking in the first place, but risks that the private sector is unable to because it's a first-of-a-kind project. It's trying to do transformation. It is innovative in that regard. So in that context, it's also essential to maintain flexibility in terms of how public funding is provided. The public funds have to have a higher appetite for risk than the private sector. Otherwise, it sort of starts to defeat the purpose. In that regard, this goes to the heart of issues like being able to address foreign exchange risk, provide local currency financing to the extent that that is necessary for international investors, or, oh, that's my time. And finally, to end on, again, a note, avoiding market distortions. I think the whole principle of least amount of concessionality that we have been, and these are sort of lessons from a lot of the public funding that we've been utilizing, both at IFC and some of the other MDBs, but I think least concessionally needed is critical, again, to avoid market distortions and to make sure that it's targeted to risks that actually mobilize the private sector to come in and leverage the X billion dollars to 5 to 10 times that we have already been able to demonstrate it can do. So with that, I'll stop. Thank you.
Thank you, Abid, to finish within the time. And I will now request Jose Juan Gomez from the Interdevelopment Bank.
Good morning. Well, first of all, I would like to thank the organizers of this first forum of the Standing Committee on Finance for inviting us, to present some of our experiences in trying to scale up private investments for climate change, for the mitigation of climate change. Addressing some of the questions that Said put forward, obviously, we have had experience working with many countries in the region, in our case, Latin American and Caribbean. And that work has gone in different levels. We have been helping countries developing national climate change mitigation plans and strategies. And we have also tried to support many of these countries in improving the regulatory framework of certain sectors that are very relevant from the mitigation, climate change mitigation point of view, like the energy sector or the forestry sector. We have also been working for many years, and it has been our main reason of being there, trying to support the access of small, medium, and large enterprises to finance, particularly long-term investment finance. Obviously, with this new agenda of climate change mitigation, our efforts have also moved in that direction, trying to support different sizes of firms to gain access to long-term credit for their climate change mitigation projects. Similarly, and more recently, we have been working very closely, with countries and many other bilateral donors, trying to support countries in climate change mitigation programmatic or sectoral approaches through national appropriation mitigation actions. And this is a very recent area, a new approach to a programmatic strategy. And there are some lessons that we are already starting to see, that would be extremely relevant for what we are discussing here today. And finally, and I think this is also important, many countries in our region have been embarking on putting together climate change or green funds. And there are also some very interesting lessons that can be derived from those experiences that they have had so far with these particular instruments. Regarding experiences, and I think that this is one of the big issues that have been addressed, in this morning, is whether there is enough financial resources out there, to support climate change mitigation efforts. When you look at Latin America, what you see is a lot of liquidity in the financial markets. I mean, basically, the money is abundant. The problem is that the projects are not abundant. And I think that this is a fundamental issue that has to be addressed, if you really want to scale up anything, because you can scale up things if the projects are out there. And the reality is, particularly when we look at the small, medium enterprises and efforts, to improve climate change mitigation in those particular sectors, is that there is a lot of deficiencies in terms of putting together bankable, monitorable projects that are technically robust. On the financing side, even though there is a lot of liquidity, and this brings me to one of the points that was raised by my predecessor, there is a whole issue of mitigation, how do you reduce risks? Banks are very scared to get into new business models and to new technologies, and somehow this is the role of public policy, to try to support, their beginning in these new areas through risk mitigation mechanisms. And this is something that is, when you look around in the region, many national development banks working with international climate change financing have been trying to put together guarantee mechanisms precisely, to entice the private sector financial institutions that operate in their own local credit markets to get involved in this type of climate change mitigation projects. And I think this is an area where public policy plays a fundamental role. Coming back to the demand side of the market, normally what you see, and I see my predecessor was right in that as well, when he said that the private sector is not homogeneous. Basically, you have very large promoters who have the technical and financial capacity to put together, their investment projects. But the reality is, in our countries, developing countries, that the majority of the firms are small and medium and micro enterprises. And if you really want to create scalable processes in this country in climate change mitigation, you have to work with those firms. And that poses a phenomenal challenge in the sense that you have to articulate very important alliances with different relevant market actors to try to structure the demand side of the market, because otherwise that scaling up is not going to take place, particularly in developing countries where the vast majority of the firms are small and medium enterprises. In that regard, I think that, we have had a very promising results, with national development banks. We have found an actor that can play a very catalytic role and a very coordinating role in the market, trying to put together the different actors so that you can start to put together bankable, technically robust projects that can later on be funded by the local financial institutions. If you look, for instance, the experience that Mexico has had with the Climate Investment Fund, and the interesting thing is that most of the resources have been channeled through national development banks. And part of the reason being, that these institutions, having a public policy mandate, have taken it to heart to promote this type of investments. And also they are knowledgeable about financing long-term investments. And I think this is very important, that they understand the risks and the fears that both the commercial firms and the local financial institutions have with these type of business models and technologies, and then they can start to put together programs to support these actors into getting into these type of investments and to address some of the risk and return problems that they may have, with this type of investments. Another important lesson, and I think that this is moving forward, as you know, NAMAs are becoming, a very attractive mean of putting together programmatic approach in climate change mitigation projects. And I think that this is the right strategy. Basically, you need to try to aggregate, projects in order, to have a meaningful impact. However, we are also seeing a trend that is a bit worrisome in the sense that a lot of people, or a lot of countries, when they put together the NAMAs, they are basically looking at the cost benefits of the inherent technologies or business models that they want to promote in their sectors. And obviously, if you look at a cost abatement curve, you could say that there is a lot of potential in many energy efficiency investments in any country in our region. However, that abatement curve that is not saying anything about what are the local market conditions in terms of investment and financing. And I think that if you want to have successful NAMAs, you have to think in terms not only of the underlying cost benefits of the technologies and the business models that you are trying to support in a particular sector, but you also have to look closely and then underlying financial conditions and investment conditions in the particular sector that you are trying to intervene. Because otherwise, you may have a wonderful NAMA, you will get a lot of non-reimbursable grants from donor countries, but you will never get investments. Because basically, no one thought about the underlying financial conditions of the sector and of the local financial market. And I think that this is an important lesson that has to be taken from this event because NAMAs are here to stay. I think that they are becoming a major instrument or a major scheme by which countries are trying to move forward, the climate change mitigation agenda. And in that regard, it is extremely important that for the sectors that you want to intervene, you have a clear picture of what the underlying conditions are in terms of investments and in terms of finance, and what are the real constraints. Thank you very much.
Thank you, Gomez. Now I will open up the floor for questions, comments, reflections. Yeah, please. I would request the participants to be very brief and specific in questions and asking questions.
Thank you, sir. I would like to share our experience in financing from the private sector. Some of the key areas where some help could come is in terms of benchmarking the performances of various technologies, without which the finances feel a little bit handicapped in terms of comparing the technologies, in terms of reliability of such technologies, so whether we have adequate certification, whether there are enough support system which can help the new technologies to, say, for example, say that it is safe for people to use in the case of, let's say, gas, or in the terms of such thing in terms of, say, government policies for acceptance of the new technologies, and so on. Other than benchmarking, our certification, we need the, in terms of regulatory risk, what all of you have said about predictability of the government policies, and in terms of ability of the government to carry forward the promises that they make from time to time. So these are the things that can help in terms of bringing in the private funding. Basically, technology certifications, benchmarking of various technologies. Like for example, solar can be $1 million for 1 megawatt. Somebody says it is 5 acres of land that you need, and that again depends on the technology. Similarly, wind, if you take the wind mapping, so on and so forth. So when we say solar, we have the solar band, and it depends from place to place. So how much we are equipping the private sector in terms of understanding our own industry will bring the two together in terms of matching the minds is, I suppose, the key to bring in the financing to this sector.
Thank you for this comment. Please, the gentleman in the front. And then.
I am Takashi Hongo, Mitsui Institute. My question is first a bit. The Basel III require private banks to improve the cash position and liquidity. I understand that the private bank play important role for mitigation, and I believe private bank should more than now. So what do you think about the impact of the Basel III on the bank lending or lending by the private bank, particularly long-term financing? And the same question to Big Ram, sorry. So what kind of solution can IFC or public bank can offer to the private bank to solve such kind of Basel III issues?
We can take a few more questions, and then maybe I'll request the panelists to respond.
Thank you, thank you. I thank especially the speakers for the interesting speech. I am Emel Bida from the Renewable Energy Regional Center for Renewable Energy and Energy Efficiency. It's more comment than question. I think that in addition to the financial issue and to the risk, policy risk, there is one barrier which is maybe we can consider it from the main barriers, the lack of legal and regulatory framework, especially in the developing countries. The lack of regulatory framework doesn't encourage the private sector to go and to invest in developing countries. For sure, the investor, if he is not confident to invest in countries where there is no clear legal framework, it's not something which can encourage the private sector to go, especially in developing countries where the subsidies is also a main issue. The energy prices are subsidized, and the subsidies of fossil fuel makes the price very low. So an investor to go and to make investment in the renewable energy field or energy efficiency field where the cost can be higher, maybe 5, 10, more than the price of energy produced from fossil fuel, I think it's not something which can encourage the private sector to go to mitigation action in developing country. Thank you.
The gentleman in the fifth row.
Hi.
Okay.
My name is David Lunsford. I just wanted to make a couple of comments in regards to Mr. Healy and Mr. Ban Ki-moon's presentations. I agree with you strongly, Mr. Healy, that there's so much in the CDM that should be referenced and potentially carried over into any developments in the future. And I just wanted to say that I think that this discussion really needs to feed into a lot of the action and deliberations happening in this standing committee and the Green Climate Fund board, and maybe even in the CDM executive board itself. I mean, just thinking about what could be carried over, I can list a number of different aspects. Some are, of course, potentially politically charged, and others are not. There's scoping, there's baseline setting, eligibility criteria, additionality, the governance process, MRV and auditing, registry, et cetera. I think just to avoid some, let's say, less politically charged issues such as the avoidance of double counting, maintaining environmental integrity, you could pilot a number of these different elements. And I think that, practically or even hypothetically speaking, it's time to start really discussing how this can happen. I mean, the CDM, I feel, and I think a number of other in this room, has had its weaknesses, but one of the best successes of the CDM has been the fact that it's evolved considerably over a short amount of time, and it continues to. On top of that, it's of course established an IT system and an MRV process for greenhouse gases that is really unmatched anywhere else in the world. So I really hope that some very practical thoughts and discussions on preserving elements of the CDM, even if the names are changed, are put into great thought and attention. Thank you.
Hello. My name is Lababi from Morocco. I have just a comment, compliment on the last presentation. It was said that the intervention of financial institutions is key for small, given the, small and medium enterprises. I think it's also a key for the public sector, especially for municipalities, for cities, and I think that we have a very good experience with municipalities, biogas, and in the landfills, and the role of the National Municipal Bank was very instrumental on putting together this project under the CPF and providing the required capacities and needed knowledge to register the project under the CDM. Going back to the CDM, we have been practicing CDM for the last 10 years from the start, developing, validating, reviewing, and moving to new market mechanisms. I think, of course, the environmental integrity is very important, but also we have to take into account the capacities, local capacities, to follow these procedures. And we have a very good example of success. People encourage and a registration project, but also we have private sector operators where for them was a very difficult process to go through, and they are not ready to go really to register another project under the same procedure. So they are looking for more flexibility in the procedure. So it's balance to strike, between the flexibility and the environmental integrity. Thank you.
We have overshot on time by half an hour, so I can take 2 more questions from the floor. So maybe the gentleman, yeah.
Yeah, thank you. I have a question according to the CDM. We know that there is a second commitment period for the Kyoto Protocol, and its mechanism, one of them is CDM. But I'm asking about the new convention after 2020, and all over the world, developing countries will committed to reduce the greenhouse gas emission. So is it useful for the developing countries to continue to make a new project under the CDM, or make it as a potential for its NAMA in the future? Thank you.
So one question, yeah.
Sean Kidney from the Climate Bonds Initiative. Is that working? Sean Kidney from the Climate Bonds Initiative. Wonderful to see a star-studded cast up on the stage. I've got a couple of questions about bonds. The cost of finance is obviously the primary issue in many markets. Because of the high capex of renewables, notably, buying down the cost of finance is obviously the biggest task, the biggest contribution we can make over a longer period. Can I get you to make a couple of specific responses about the idea of credit enhancement for green securitisation in emerging markets, Southern Africa, Latin America, and also, a comment especially for you, Abid, credit enhancement for corporate bonds as a way of getting this market going. And I'd refer you specifically to the State Bank of India's credit support for the Suzlon bond recently in India, and the potential for that being a model for the development of bond markets in countries where they don't currently exist, knowing that most bond markets around the world have required state credit enhancement to develop in the corporate sector. Those two themes.
Last question from the floor, please.
Thank you very much. My name is Gareth Phillips from the Project Developer Forum. I have a question maybe for Hugh Seeley and Mr. Gomez. My concern is about the really the practical aspects of implementing projects and the capacity that's required on the ground. We see the CDM as a project-by-project approach, highly focused on identifying specific assets that can then be taken forward and developed. Whereas when you look at a NAMA approach, a sectoral approach, a broader approach, you need to have significant institutional capacity in order to take that forward. And you know, maybe going back to Mariama's point at the start and some of the points that Abid raised about reaching out to the economic dislocation and reducing suffering and so on, how do we reach the sectors of the economy that don't have the institutional capacity to develop projects if we don't have a project-by-project approach? And do you think that's essential to reach those sectors of the economy? Thank you.
Thank you. Maybe now I'll request the panelists, maybe Abid and Vikram first, and followed by you and Mr. Gomez.
Okay, so let me start with Takashi's question about the impact of Basel III. So it was interesting because, of course, Paul from Nicaragua gave a very interesting presentation, and he talked about financial regulation and suggested that maybe finance had the upper hand. And I think Basel III is an example of perhaps an unintended consequence where there are severe restrictions that have a knock-on effect to clean energy project finance, as an example, where because banks have to now, and I'm not an expert in this, but essentially banks have to keep, have to increase their Tier 1 capital ratios, clean up the balance sheets. This essentially means that the ability for most private banks to be able to fund long-term projects has diminished significantly. And in practical terms, what this means is that for longer-term renewable projects where in the old days, banks would be willing to provide lending up to 12 to 15 years, let's say, that's very much disappeared. The sweet spot, unofficially, let's say, is in the 5 to 7 year range for those banks involved in project lending. So that's a significant challenge because it means that there is now this gap that exists between, let's say, the 5th to 7th year of financing and the longer tenor. And I would suggest that that's an area that perhaps the Green Climate Fund needs to look at as it thinks about the kinds of mechanisms required. The second question, the lady, sorry I missed your name, but you talked about the fundamental importance of a strong legal and regulatory framework, and would wholeheartedly agree. That was, in my context, that was the investment grade policy prerequisite that an investor is looking at. And I just wanted to bring it to a specific example because I think that makes it easier to understand. So, one of the things we looked at was, can we get involved in financing energy access in East Africa? And what we came across was that, yes, there are some great businesses operating in East Africa. They've got the ability to help replace kerosene, which is used for lighting, with solar lamps, I should say, and in some cases rechargeable LEDs. These technology costs have come down, business models are there, the scalability is there. Two problems. Kerosene is massively subsidized, and because the equipment is coming primarily from outside East Africa, there are import tariffs being imposed on solar and LEDs. And so it was only through a process of engagement with governments in East Africa, through a variety of the forums that many of us participate in, that we were able to help achieve the reduction of the VAT. Not quite address the fossil fuel subsidy question yet, but I think it at least levels the playing field and allows many of these projects to happen. The third question from David I wanted to tackle was about CDM and are there any lessons for the GCF? And I think there are definitely. All the things you talked about, those are positive. That's part of the data bank that needs to be carried forward. We mustn't, forget all of the experience and history that we have. We must carry that forward into all of these new mechanisms. But I think Vikram raised a really important issue, which is, should the GCF go the wholesale route, i.e. focus on large-scale deployment, which is probably not going to be at the project-by-project level, or should it go, let's call it the retail route? Should it get involved in funding projects on a project-by-project basis? I mean, that's a question that's still open as part of the whole debate ongoing this year with the business model framework of the Green Climate Fund. In my opening remarks, I talked about the need for these three complementary approaches to try and address these very specific barriers that we've seen in impeding private capital. And based on that analysis, I would argue we absolutely need both approaches. We need the wholesale approach to try and provide some of the risk mitigation instruments at scale. Somebody else asked a question about low-cost debt. I mean, that would be a way also to deliver subordinated debt, which could help to get more projects across the financial clothesline. But at the same time, we need a retail approach, which will involve project by project. And maybe, as an example, given that we have, as Hugh said, a really challenging CDM market, why not look at a mechanism that provides what we call an emission reducing underwriting mechanism, essentially a pay-for-performance CDM-like payment that helps ensure that there is a return that's going to be there for investors in the case that the CDM market doesn't recover. That's an example of what's called a results-based approach, which could be delivered through the GCF, through a retail window, that would help ensure that all these projects that have now shifted from the larger emerging markets to primarily the least developed countries would be able to get those projects across the line safely, so that we'll see a growth in the pipeline. And I guess I have to address Sean's question briefly. I mean, Sean, this is probably more of a question for my multilateral development bank colleagues to my left here. Because ultimately, they're the ones that have to provide the credit enhancement. But from my perspective, yes, absolutely, we will attract more investors if we can increase the quality, perceived quality of these bonds, improve the rating by offering them the wonderful AAA wraps that these guys have that most private banks don't have, and that I think would certainly help unblock the green securitization market. Thank you.
Not so quickly, Abid. Hold that thought. I'll come back to that in a minute. And let me go back to Hongo-san's question on Basel III. And I think in some ways it's a continuum. It's kind of clear. I mean, Abid said it all from a commercial bank perspective. And there are some pension funds out there who have gone as far as to say that the institutional pension funds and the other institutional investors are going to become the long-term financiers for a lot of what is needed. It's in a perfect world, it's wonderful. They can invest for 15, 20 years, even longer. They have long-term liabilities. They could do with long-term assets that provide a steady risk-adjusted yield. And therein lies some of the problem. But what we are trying to do, since you specifically asked, is to see how we can at least do something that tries to address some of that risk-return equation. And it's not going to happen that straightforwardly. It will require some amount of public concessional funding. It will require us ourselves structuring a portfolio so that perhaps we co-finance these and subordinate ourselves to senior lenders, or to the senior lenders, who in this case end up being institutional investors rather than commercial banks, because commercial banks are withdrawing from the long-term market. And we can see that even in our syndications program. So we are trying those things, and I'm going to link sort of the second part of that answer to Sean's question about green securitization. And I think that's where a place where we should be getting to. It's not two reasons why we can't be there. There's not enough deal flow in sufficiently advanced to be able to securitize to this kind of scale that institutional investors want. But that doesn't mean we shouldn't start on that. And I think that's where I would, for the swap, in exchange for a credit enhancement, I would suggest the commercial banks, who can now only do probably 3 to 5 year, ideally, if maybe longer, as Abid says, but if 3 to 5 year is their sweet spot, then can we structure the flow in such a way that the commercial banks come in for the early stage of the project that is higher risk, which the institutional investors don't like, at which point, at the end of that, and of course with the multilaterals alongside and provide, and then securitize this pool of assets, take out the commercial banks and their short-term lending and swap it for more stable long-term lending from institutional investors. That then is already past the initial risk of the portfolio and can then, yes, it means lower yield, but it also means much lower risk, and hopefully we get to sort of the risk yield, risk reward that way. And for that, I think we need to develop a larger pipeline. We need to build the portfolios, whether in South Africa or Latin America, in order to be able to securitize to scale. And then it's not just a question of doing the first $1 billion bond with that kind of securitization. Once you sell it in the market, you're going to need the next 5, 10, 100 billion to follow very soon in order to service that market. So stop that.
Yeah,
Thanks, Said. Lack of legal and regulatory frameworks. Agree with that. And this is part of the push and pull that I think Paul was alluding to. And I get weary when I start to agree with Paul. But I think that's a fundamental, and we do have a lack of capacity in our particular region. I'll give you an example. We have non-functional public utility commissions. In Barbados right now, there is a fair trading commission that is dealing with the water sector and the energy sector. Last week, there was a discussion about renewable energy with the utility companies, hearings with the Fair Trading Commission. The lack of institutional capacity is obvious when the utility company, which is a privately owned, Canadian-owned company, says we will do the study to determine how much solar PV we can take in our grid without instability occurring. You shouldn't allow the utility company to do that study. It should be the regulator that will be doing that study. There were two specific questions on NAMAs and markets. I believe my colleague from Egypt said or asked, should developing countries continue with the CDM or should they switch to NAMAs? I don't see them as mutually exclusive. They are not mutually exclusive. You can do both. You can register a NAMA and then apply for a accredited NAMA. The advice that we're giving colleagues is do not abandon the CDM at this point, even though the price is less than $1 per ton. A smart businessman buys low and sells high. So get in now, but do not enter into a purchase agreement with a developed country partner, not at $1 a ton. The price will rebound. So hold on to the CERs and sell them when the price goes up. Gareth, you mentioned about the significant institutional capacity that would be required for NAMAs, and your point is well taken. This is something that small islands are also concerned about, because we believe that if we move to a purely sectoral approach in a new market mechanism, that small countries will be disadvantaged. There are some overlaps between what the CDM is doing and what, on a project basis, and what a sectoral approach would have to do. You still have to determine your baselines. But things like crediting thresholds, et cetera, to leave that up to the capacity of the government is going to be problematic for some countries.
Okay. Regarding Mr. Rao's statement about the need for support systems for the adoption of new technology, thinking particularly in terms of standard setting, standards for the technologies that are going to be adopted and so on. I think this is fundamental. Not only in terms of the different technologies, but also having the institutions that somehow regulate and oversee that the standards are actually implemented. And this is not only important from the point of view of the return of the investments, but it's also extremely important, and we have a very clear example of that in one of our projects for the financial market. Basically, we are working now in Colombia in an energy efficiency project for the services sector. And one of the fundamental issues there is whether the investors will take on the investment, and it will depend fundamentally on the fact that the actual energy savings materialize. Therefore, you have to give them some level of assurance, that this thing can happen. And this is when you bring these standard setting institutions, because in a way they are the ones who are going to supervise the quality of the technical quality of the projects that are going to be presented, to the financial institutions. They will intervene in the setting of the monitoring scheme, okay, or not the setting, but the actual monitoring of the results of the project. And because of the fact that this institution is involved in the system, an insurance company, a local insurance company, has come forward and have proposed to develop a performance insurance policy for energy efficiency projects, so that the actual the technical company that will be supporting the firm structuring the project basically buys this policy from the insurance company, and the beneficiary will be the investor that will be actually taking up on the investment or on the financing. The insurance company is only getting involved in this because they know that there is somehow a third-party technical third party that is revising the design of the project and helping with the monitoring of the results. And I think it is extremely important. The second thing was raised by the gentleman about the role that national development banks, have also played at the municipal level. We have experiences in Latin America where they are actively involved in the structuring of NAMAs for solid waste, sustainable transportation, and public lighting. The same case that in the case of the firms, many of these municipalities and also private sector companies that are engaged in the delivery of public sector goods, they are being financed through these development banks with these particular type of projects. The third point was raised by the gentleman about the institutional capacity for NAMAs. Here I think that the answer for that is that you have to integrate different actors, relevant actors that have an incentive to be involved in this. In our projects, the ones that we are doing in the forestry sector, in the energy sector, in the transport sector, normally you have providers of technology, providers of technical services, standard setting firms, in the national economies, and local financial institutions, including banks and insurance companies. They are all engaged, and there you have like a coordinator that in our case was the development bank. The development bank somehow articulate the interests, and somehow try to negotiate, potential incentives with government so that these actors start to work in a synchronized fashion, trying to support this particular type of projects. And this is the way that we have approached that issue.
Yeah, very briefly,
Very
Vikram, if
briefly,
you can.
I actually, in addressing those, I just wanted to take the opportunity to, after having disagreed with the chair of the CDM board, I thought I should agree with him, the vice chair. I should at least agree with him, and I totally agree on the fact that the NAMA and CDM, I don't think it's necessarily mutually exclusive, especially as a colleague of ours phrases it, if you think of NAMAs as sector policy, which is sort of driven, of course, in consultation with national stakeholders, combined with MRV for the greenhouse gas emissions that come from said sector policy, if that's what a NAMA really is, then I think there's nobody else who's written the book better on MRV probably than the CDM has. And extending that, I think, once again, multiple asset classes, whether they're NAMAs, whether they are project-based, which I think should not, under any circumstance, be allowed to go away, I think can all coexist along with yet-to-be-defined mechanisms. And countries should be free to do what they want, whether they want to do an emissions trading scheme, whether they want to do capped emissions, whether they want to do energy intensity. We just should be able to find a way of creating some sort of fungibility and equivalence across them. And so I'll just sort of stop there. Thanks.
This was a very lively discussion, and the time lag which is queuing up, so in the interest of time, I would request the participants to take coffee, and this is to bring along your coffee over here, so that we can catch up on time. And the next session will start off at 12 sharp. Thank you.
Thank you.